Good morning. Hi, I'm Doug Holtzaken. I'm president of the American Action Forum, and I want to first and foremost thank you all for coming today's discussion about the housing market in California, what the United States can learn from California and vice versa. The American Action Forum has actually done these types of events in a number of places around the country. We've been in Las Vegas, Phoenix, Columbus, Ohio, Washington, D.C. We're here today. We'll be in Orlando, Florida. And in every case, I have to say, we have benefited from the quality of the discussion and the fact that there is no single housing market. Every place is a little bit different, and it's just been fascinating to do a tour of this particular issue. I do want to do a couple of pieces of shameless self-promotion. First is that if you're watching on the webcast and you have a question today, you can tweet it to at AAF with the hashtag AAF Housing, and we'll get your questions into the mix. We also will have a paper available online describing our take on the California housing market and comparing it to national averages. And I thank Andy Winkler for his work in that area, and he leads all the housing work at the American Action Forum. I should take this moment to thank the staff in general for putting on this event. I am merely a figurehead. I show up, I do nothing, and it's all working great, and I'm really pleased. And then lastly, I have the distinct honor of introducing our moderator for today's panels, who I'm going to ask to come up and introduce the panels. Greg Lucas is a contributing editor at the Capital Weekly, and he also has his own blog, California's Capital. According to his bio, he has covered every dull, boring issue that has ever arisen in the state of California. Is that a fair assessment? In a career that began as a Stanford undergraduate, got a master's degree at USC, has had stops at the San Francisco Chronicle, and reaches a new peak in his professional career by being here today to moderate our panels, and I invite him up and thank him very much. Thank you.
I was going to sit rather than stand. Nobody minds, right? Okay. Actually, you know, my most challenging job was working as a ride operator on Pirates of the Caribbean. And that's one of the reasons my daughter buys me a lot of these pins that have skeletons and skulls on it. This particular one is a Tyrannosaurus Rex, and if she were here, she's 20 years old, she would tell you that that's what I am, a dinosaur. So our first talk is about the use of eminent domain as sort of a mechanism to help homeowners whose mortgages are underwater. And there's three panelists who are joining me. One is Gideon Canner, the professor of law at Loyola Law School in Los Angeles. Are you going to come up here or do? Okay. Paul Herrera, the Government Affairs and Communications Director for the Inland Valley Association of Realtors. You must have had a fun last 3 years. And David Min, the Associate Professor of Law at the University of California in Irvine, who's an expert on financial markets regulation. And when you guys are settled, well, you guys make it work for you. I'm just the know-nothing moderator. Well, you don't have to agree so quickly.
It's deceptive.
So, I apologize, but I thought maybe we could start with a know-nothing moderator question, which is, I don't think of eminent domain being used in the manner that's been suggested both in Sacramento and Elk Grove, for example. And can somebody tell me how that works or what the concept is?
Sure. Eminent domain is the inherent attribute of government which enables it to take private property for its needs. The Constitution, the Fifth Amendment, puts two ostensible limits on it. One is the taking must be for public use, and the just compensation has to be paid. In the real world, the U.S. Supreme Court has essentially written the public use provision out of the Constitution. Just compensation is still payable, but it kind of reminds me of the historian who said that the Holy Roman Empire was neither holy nor Roman nor an empire, and just compensation is neither just nor compensation. The Supreme Court has repeatedly acknowledged that. Courts generally do. There's a variety of losses inflicted by eminent domain that are not compensable. That's the quarter definition of a problem. Now, as you apply it to mortgages, we have an entirely different problem. As far as I can tell...
It's an untested area, though, right?
Yes and no. Stay with me.
Okay.
There is little doubt in my mind that on the basis of existing U.S. Supreme Court black-letter law, it can be readily done. Whether the U.S. Supreme Court will stick to that law in this case, this kind of requires me to leave the realm of the law and gaze into my tea leaves. I assume everybody in this room knows about the Kelo case. That was the taking in Connecticut where the court said the government can simply take an unoffending, perfectly proper neighborhood and turn it over to somebody else for redevelopment, and that's public use, period. There was an uproar. Court was split 5-4. There was a national uproar that produced the highest disapproval rate in history, which is around 90%, unheard of in political polling. And there is a possibility, I don't consider it anything but a remote possibility, that the justices, being human, must feel pretty scalded by this. Because this was not some deeply emotional issue like, say, Roe versus Wade, which was terribly controversial, but there was a split of opinion. Here, there was an intense reaction, and it was all against them. So there is a possibility that they may, you remember Mr. Dooley, the fictitious Irish publican who used to say, I don't know if the Constitution follows the flag, but I know that the Supreme Court follows election returns. So I don't think they follow election returns, but they are not oblivious to what's going out there. And this case provides a perfect vehicle for the court to back off a little bit and pull up its socks and say, well, yeah, we still look upon the power of eminent domain as being broad and subject to very limited judicial review. However, in this case, you may have gone too far. This is not a prediction, this is a possibility. The state courts are, following Kelo particularly, have also backed away from it, and there's been a number of cases by the Supreme Courts of Illinois, Michigan, Ohio, Georgia, South Carolina, Oklahoma, and some others, where they said, no, we will not go as far as the U.S. Supreme Court, which they have a right to do because under the Constitution, the states may provide greater rights to citizens than the U.S. Supreme Court's minimum. So there is a possibility that this thing may be a little hinky. And finally, to get to my real point is that this is almost irrelevant. The real problem with this proposal is going to be valuation. And I would probably need more time than I have here to explain. But basically, just compensation means fair market value. I don't know, maybe the other experts here do know, to what extent there is a market in underwater mortgages and what kind of prices they bring. I am certain they are not worthless, particularly the ones where the homeowners still continue to pay, which was the primary target of the promoters of this idea. They have since, I understand, broadened it to also include underwater mortgages on which the homeowners have defaulted. Valuation, what is missing from the discussion is the rules concerning partial taking. Because if you're going to take one mortgage, you reach out and you take it. But what happens if you have to take a part of it? Because a lot of these mortgages have been bundled and provide security for mortgage-backed bonds. So if you take one mortgage out of the bundle, you will affect the value of the rest and the value of the bond. To the best of my knowledge, nobody has ever valued that in litigation. So I simply don't know how that one will go. All I want to do is caution you that if this scheme goes forward, there's going to be a very large and very difficult area of, when was it, in the 15th century, the cartographers used to have maps, and then on the edge it said, "Here be dragons." Here be dragons. It hasn't been litigated. It hasn't been valued. There are some things that people who talk about it haven't even considered. What if you're condemning one of these mortgages and there's also a second? You're going to affect the value of it, and that raises the eminent domain flag of severance damages. That is, if you have a partial taking, you also have to pay the diminution in value to what you leave behind. There are going to be some very interesting problems if that goes forward. So far, to the best of my knowledge, nobody has actually filed, so all that remains yet to be seen.
I don't know, Paul, what do you think? I mean, just from kind of a practical standpoint, is there some benefit to the state's depressed real estate market?
I can only speak to San Bernardino County and the proposal that we saw from MRP in that market. And what we saw in our region as a possibility is a very narrowly tailored taking that would affect essentially 10% of 10%. You're looking at about 10% of the market that is privately owned securities. And based on recent data, about 10% of those, the performing ones, that are actually defaulting. So one of the things we started looking at right away is that you can't have a broad impact on the housing market by somehow saving 1% of what's out there. So when we start talking about whether this can really make a difference and there's a benefit to the region, I can speak to our region. And in our region, it's hard to make that case, to connect 1% to an argument that says...
Because it's such a teeny sliver.
It's such a small sliver of mortgages that aren't defaulting. Now, there's been an expansion and definition of how they would approach it, but we haven't seen any documentation on that or really have a sense for how that would work, because the mechanism that allows the investors to cash out, essentially, right now, based on the previous plan, doesn't quite follow if the homeowner cannot qualify independently for a home loan that allows that process to complete. So is there a benefit? It's hard to connect the mechanism to a benefit, and the risks that it brings to the market are very disconcerting.
Well, broadening the question a little bit, how is the housing market in the Inland Empire?
Improving. Quite a bit.
There's nowhere to go but up, right?
The housing market in the Inland Empire, one of the things that becomes part of the discussion is there's no need to stabilize home values or the market. The market's been stable for 2 years plus. It bottomed around 152 in median home price in the area, and based on valuation, it just stuck there. Obviously, there's been the impacts of foreclosures, which has been difficult and painful on the market. But those are starting to come down. We're seeing now 6 solid months of growth following 2 years of just bumping along at the same pace. And now you look year-over-year numbers. You have 12% year-over-year valuation growth. You have foreclosures down about a third in inventory. You have pre-foreclosure inventories down by about a third. All these numbers are pointing in a very positive direction. Are we, is the pain gone? Absolutely not. It's a tough place. The San Bernardino County, Inland Empire, this is home for me. And, I spend my weekends playing poker with a lot of friends who struggle through it. But they
You
don't.
mean because you're such a good poker player?
I actually won a little bit last time, but several of them lost their homes or gave up their homes. None of them ask for some major government intervention to save them from the situation. They don't like it, but I haven't heard anyone really call for this kind of move.
Professor, what do you think about, I mean, this seems novel to me, this use of eminent domain. It's kind of, in fact, sort of an alien concept to me, but.
Yeah, I think it's novel, and I think Professor Kanner and the other panelists, Paul, point out some real difficulties with the proposal in any way, shape, or form, whether we're talking about the MRP proposal or eminent domain generally. Eminent domain is a inefficient, time-consuming process. This particular use of eminent domain, as we can see, is going to be subject to a lot of litigation.
What's the public benefit? Exactly?
And that was what I was going to get to. I think we're ignoring the problem that this is designed to address. And I think what's happened is that local lawmakers in particular have just gotten so frustrated with the lack of positive solutions to what is a very real problem. The large overhang, the large number of vacant homes, a large number of homes in foreclosure or at serious risk of foreclosure. We've had 3.5 million foreclosures since the financial crisis. There are another 2 million loans in the foreclosure process today. And we're looking at about 7 to 10 million loans in serious risk of foreclosure in the near future, including 3.5 million loans that are already delinquent, 1.5 million that are seriously delinquent, more than 90 days. Most of those are probably going to, that last category in particular, are going to probably turn into foreclosures. We have 10 million vacant homes in this country. And these are real problems that don't have solutions right now from D.C. or from the banks. And by the way, these have very large negative costs. They have costs on the investment pools. They have costs on their neighbors. Just to give a few of these costs, an average foreclosure, because of the high cost of administering it, reduces the value of a home by 27%, reduces the value of all other homes in the neighborhood by 1%. A typical foreclosure costs lenders and investors $50,000 in lost value. It costs borrowers $7,000 in administrative costs, and it costs local governments about $34,000 in lost property taxes and other expenses. It also causes, just by virtue of the lower home prices, about $200,000 in aggregate lost home prices for each foreclosure. So in 2009, for example, we had 2.4 million foreclosures that caused property values to decline, a total of $500 billion in spillover home price depreciation. So these are real problems, and these negative external costs are not being addressed. We've had a number of programs, the HAMP program, the HARP program, making home affordable, Hope for Homeowners, and they haven't really reached the desired effects. And so, I think this particular solution, it is one that's going to be inefficient and time-consuming, and probably never going to happen, to be honest. But I think
you say that?
you talk to experts. I think just administering it is a problem. I think it's very difficult to implement, and the prospect of so much litigation, I think, is probably a deterrent.
But see, all your statistics would suggest to me, I'm sorry to interrupt,
sure,
that there is, in fact, a public benefit.
Absolutely, but if you're talking about something that's not going to happen for several years because a judge has issued an injunction, and you're tied up in litigation with high costs to your city for several years, that's not an immediate solution to an immediate problem. And so I think that people are frustrated, in particular because. What I think we really need right now in the eminent domain proposal sort of reflects is a stick. The banks are carrying large inventories of loans and mortgage-related securities at very high valuations. They have a lot of, whether it's the bureaucracy, the valuations, or other factors, they're just simply not addressing these loans that are at serious risk of foreclosure in the way that I think from a public policy perspective makes the most sense. So again, I guess I'd say there are real problems with the eminent domain proposal, but I think we need to keep in mind what it was designed to address and why it is there in the first place. I think people are just feeling like there aren't any solutions coming out of Washington or Wall Street.
Well, it's slightly off the subject, but so what would is there an immediate solution? Is there something that could be done now that makes it better?
There's some things that are making things better.
It's different from state to state. It's different from region to region in California.
Right. So, you know,
I'm not sure there's a one
from my own perspective,
thing,
and I think there are people in this room that will disagree with this. I think principal reductions, you know, lowering the market value, the functional goal of what eminent domain is trying to achieve here, reducing loan balances down to a level that reflects the market rate, is probably a solution that maximizes value for investors, society, and for homeowners. Yeah, and
I agree with you on principle,
Mm-hmm.
but we got a nasty little problem, and that is that the status quo ante rule of the Internal Revenue Code was that if a part of your mortgage is forgiven, the IRS looks upon it as income. Mm-hmm. The Congress passed a statute which suspended that provision, and that suspension runs out at the end of this year, and it is probable, but not at all certain, that Congress will extend it. If they do not extend it, it means that any solution of that kind that reduces the balance on the mortgage, you disagree?
No, yeah, I disagree.
I want a tax maven. I am not one. So please educate me.
Go for it.
Well, no, to the extent that the homeowner has assets.
Well, you speak up, be an opera singer. Go for it.
To the extent that the homeowner has assets, he has a tax when this is finished, he has a tax liability. Right? So
Yes.
the extent of his tax liability is a function of his remaining net worth after the forgiveness of the debt. If the debt, for example, is written down from $300,000 to $200,000, leaving the homeowner with $10,000 of equity in his $200,000 house. His tax liability is $10,000. On the other hand, he's been forgiven $100,000 of debt, not taxable.
Well, thank you for the correction. The point is that however you slice it, there is going to be some kind of tax liability, which will come as a nasty surprise to a vast majority of these people, the homeowners.
Why would it be a surprise if they were told that?
Sir, what can I tell you? Ignorance of the law is no excuse. That's why we have courts of appeal, right? Because that's too subtle for you. I should mention two things that I should have. Because number one is that tax thing, and
I was going to say you had that written in big letters.
yes, I did. I think we straightened that out. And the other one is that in California we don't have mortgages. We have deeds of trust. So foreclosures are non-judicial and very efficient. So some of the problems that concern my colleagues here about the complexity and time, the horror stories from Florida that we've been reading about would not happen in California.
Except for the homeowner.
Well, yeah, losing your house is a nightmare. What else is new?
You just wrote something down.
Oh, I was just writing down non-judicial foreclosures. Nothing.
Go for it.
Well, just to continue answering your question, so I think that the state AG settlement may have some effects because that focuses primarily on principal reductions. The state attorneys general, I think earlier this year, reached a settlement with the largest banks and servicers.
And we signed the governor signed a law that sort of extends the same requirements to other lenders as well in California. But
right, and so this was related to the robo-signing foreclosure issue, which was intended to speed up the foreclosure process, but it sort of violated some of these due process rights. And what ended up happening is they ended up settling, and they got agreements from the banks to kick in a sum of money, which is significant, but probably not enough to make a large dent. But this will go primarily towards principal reduction for borrowers at risk of foreclosure. And so that'll help, but I think that we've tried programs with a lot of incentives, giving banks carrots, and those aren't working. It's really the sort of kick in the butt that's really reached those desired results. The big one that didn't pass was bankruptcy reform, and again, I know a lot of folks in this room don't agree with that, but I just think that we're seeing a lot of inaction and a lot of frustration at that inaction. And that's kind of what motivates this particular solution and why it's become so popular among certain jurisdictions.
go ahead. You want to say something?
Yeah, there is no trouble-free way to address a problem that inflated to the extent to which we saw 5 years ago. And one of the real dangers that we've seen play out over and over again is that we have gone chasing those rainbows, that somewhere where there's a solution that fixes everything without any consequences. This one comes along and clearly has consequences, clearly has drawbacks, has concerns. And it's not even a concern of the slippery slope of what's next. This is the result of the slippery slope of what happened 7 years ago. 10 years ago, actually. And to keep looking for that is, look, it's always good to imagine and dream and try to find it. But it took a lot of work and a lot of mistakes and a lot of behavioral problems, frankly, from a lot of places to get to where we got to. And throughout history, there's example after example where pain was wrought from the mistakes we make and then corrected because that's what we do. We get back to a point of equilibrium. And now, what consumers need, what homeowners need, is a stable housing market, one in which the fundamentals are there. People can afford the homes. It makes sense valuation-wise when it comes to the cost of living, rentals in the market, and in which they can believe that next year their home is going to be worth roughly the same or more than it is worth this year. That's what we need in the Inland Empire, and that's roughly what we've
You
got.
can use that here in Sacramento too. Yeah.
I mean, we've reached a point now where you can check that box. At least it appears that way. We're 2.5 years into this, and now we're seeing solid increases. If anything, there's a renewed concern about whether there's a new bubble forming because of the amount of investment activity in the area. But overall, when you look at affordability rates, there is a strong foundation for future growth, and why we want to get involved in artificially affecting that now and potentially damaging that recovery is something that we don't want to see locally.
Yeah, I mean, what I hear from realtors in Sacramento is that we have 2,000, property values and 1990 borrowing rates. So it's like if you have money and the ability to invest, it's like a great time to invest. But I guess, a lot of people don't have the luxury of doing that. And I guess I keep coming back to this, and we've touched on it, but so, what can government do to help facilitate that sort of consumer confidence?
That's a great question, but I don't know that government is the answer to that question. Before my current job, I worked for Sacramento County.
They're the ones who got us into trouble.
There is that, yeah.
Before I worked for the realtors, I worked for Sacramento County, and I remember I was there when the NSP program came around.
I don't know what that is.
That's a neighborhood stabilization program, and the county received, I want to say, about $25 million towards a series of programs. And reporters are calling me up and saying, "How is this going to? Are you going to be able to stabilize the market with these $25 million?" And I had our economist run some figures, and this is 2007, I think, and at the time, going back into notice of default for 90 days, there was the homes that were filing for default had a combined debt of about $9 billion over the actual worth of the homes, and 21 million. So that's the equivalent of you owe $9,000 on your credit card. Someone hands you a 20. You're gonna go buy some lunch and think about how screwed you are, but you're not gonna be able to solve the problem. And there's been little levers like this that have been touted as we can save a market, but it doesn't come from government. It comes it was market created, and market is what's going to drive it back.
I just have to say that I just totally disagree with that. I mean, right now the government backs about 95% of all the loans out there. Any liquidity you see in the market is not coming from the private sector.
Sure.
And the other 5% is coming from banks that have federal deposit insurance. The Federal Reserve has kept rates at a record low. That's to help you guys. It's also hard for me to sit here and hear that the realtors had nothing to do with this problem. It was all the government's fault. When in fact,
I didn't say that.
Well, that was the tone I was hearing. I'm sorry, and I'm not trying to start an argument. I'm just, I fundamentally don't agree with the idea that government caused the problem.
The website rating.
Doug was on the FCIC, and the FCIC, all of but one member came to basically the same conclusion. One, this was a very complex set of issues, and two, it wasn't the government that caused the problem. This was a classic bubble. A lot of this bubble was driven by the surge in Wall Street securitization, which was primarily responsible for subprime lending, which was also targeted at certain types of borrowers. 61% of subprime borrowers qualified for a regular loan. They were steered towards these particular products. And what government is doing right now, in addition to providing liquidity, they're trying to fix a market problem. There are millions of homes in this shadow inventory. I also don't think that we're looking at a rosy picture for housing. Yes, we've probably hit bottom according to the consensus of most, although, if it dipped again, that wouldn't surprise me or I think anyone in this room. We've all been wrong about this. Doug and I were talking before this. We've been wrong more often than we've been right about calling the bottom of the housing market. But I think that there are a lot of strong headwinds against a full recovery. There are millions of homes that are underwater. Those particular borrowers are going to look to sell as soon as you see a modest increase in prices. That's going to keep prices from going up too much. You have banks holding on to millions of homes, both vacant as well as millions of mortgages that probably are going to go into delinquency soon if they're not there already. Those loans those properties are shadow inventory as well. So there's a lot of real headwinds, and that's not even mentioning the fact that if the economy suffers a double dip, we're in a very tenuous recovery right now. Of course, home ownership is going to suffer as well. And then, of course, there's the political risk. If Obama or Romney decide to do something that's a major departure from the current norm, we could see that affect housing as well. So I think it's really too early to say the housing market's all great. Let the private market go back to doing what it was doing in 2005, which didn't work, by the way. I think there is a role for government here because this is a classic externality problem with these high costs of external costs of foreclosures.
Wait a minute. I didn't hear any reference to the Community Reinvestment Act, which is a major culprit, not the sole one, but a major culprit, where the federal government used the weight of its force to lean on lenders to make what you guys call subprime loans, which I prefer to call deadbeat loans, to people who really, they may have been perfectly nice people, but they had no ability to service and pay off those loans. So it was all preordained.
I've actually written about this. So,
and in fact, no less a cheerleader for government power than the New York Times raised red flags long before the crash. In fact, read the stuff written by a New York Times financial reporter named Gretchen Morgenson. And she nailed it long in advance. She ran a piece, I remember the title, it said, "The Coming Housing Bust, : it won't be pretty." What else can she say?
Sure.
So the government had a big negative role in all this.
Sure. And I've written about this, and as is Doug, actually, as part of the FCIC report, as well as the number of staff reports addressing this issue. The problem with that argument, it sounds great, the government was forcing these lenders to issue loans to low-income people, is that...
It encouraged them, right? It didn't force them.
No, the argument is they forced them to because they had to set aside a certain portion to serve certain communities. Is a very small portion. The problem is the data doesn't match that up, as study after study has found. Gretchen, in her book, by the way, doesn't actually cite statistics.
She writes about Fannie Mae.
Yeah, sure. Not
so that's a somewhat different subject.
We've also, the FCIC also rejects that particular argument as well. They did a lot of research, a lot of study. The problem with that argument is that most subprime loans were not originated by banks subject to CRA. They originated by these independent mortgage companies. And actually, if you look at loans that actually were originated for CRA, they defaulted at exponentially smaller levels than loans not originated for CRA among the same populations. Because the loans that are being written to these particular borrowers, low-income, moderate-income borrowers, historically had certain types of underwriting risk characteristics that were designed to perform. What happened is you started seeing a type of loan called subprime that was steered not just to low and moderate income borrowers, but also to regular middle-class borrowers. They were steered in these loans. They had these noxious features like 228 resets, negative amortization, all the things that we associate with subprime loans. This was not primarily or entirely a low and moderate income phenomenon. It was really about, how can we squeeze blood out of a stone, force these guys to pay a high rate, and then, use that for purposes of securitization to get a higher rate paid out to our investors. That was really what this was driven by.
There are a lot of culprits in this drama. I just wanted to make sure that the government's role is appreciated.
Well, there may be ways in which they did. The Federal Reserve rates. But, I think the evidence is fairly clear, and you all can read the FCIC reports on this. CRA, Fannie Mae, and Freddie Mac were not responsible for this.
Let's take some questions from you all. Sir.
Yeah, maybe you could come in, but
I'll bet you they'll bring you a microphone.
Yeah, they will.
Sure.
setting aside the fact that there's plenty of bad actors to go around, I'm more concerned about what the effect of this proposal would have on the availability of financing for future transactions.
Good point.
Particularly if it's limited, right now, I understand the proposal is limited to performing notes rather than non-performing notes, but what would be the effect on borrowing costs in the future? We're at historically low rates right now. We could certainly slow down the market activity if we bumped even a few percentage points, I would think.
I thought it was broadened slightly beyond the non-performing notes. Am I remembering that wrong?
This sounds, no, the premise of the question sounds very logical, but I don't know that it is, because the market has no memory. You can have a disaster, and 5 years later, some opportunity like it arises again to make money, and people will rush into it. In fact, let me give you a historical example. Does the Whoops disaster ring a bell?
Yes.
WPPS, Washington Public Power, said, oh yeah. So they built a series of nuclear power plants and issued bonds. Then came the great nuclear reaction. They stopped construction, and 4 out of 5 of them were never completed, and the bonds defaulted. And the gurus were writing things saying, I forgot to mention, the Washington Supreme Court wrote an outrageous, politically transparent opinion in which they held that there never was any authority to issue those bonds. Therefore, beep, they don't have to be paid back. There was an outrage and all kinds of predictions that henceforth Washington State will have to pay higher interest rates on its bonds because they can't be relied on, yada, 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 yada. Has that happened? No. Washington State bonds are like any other state tax-free bonds. So,
Paul, I'm sorry. Go for it.
One of the clear reactions we have seen from the threat of eminent domain is that it creates a brand new loss risk for the investors who purchase these things. As a result, it has to be insured against one way or another. If there's a risk that the house is going to burn down, there's hazard insurance, PMI for potential there. Now there's a new potential for losses that are forced onto the investors, into the market. Perhaps the first time around,
the loss would be the taking of the property?
The taking at a below compensation rate, the below market rate. Those losses now have to be dealt with for the future in some kind of new insurance pool or some kind of new way of handling it. That has to create new costs onto borrowers because it has to be mitigated in some form or another. Now you have a market downturn risk. Market drops 30%. Everybody wants to use eminent domain to drop their principal. Is that going to be the approach? And how do we price that in? The concern is it hasn't happened, and we don't know how to price that in. And how's that going to work?
So just to add on to what Paul's saying, there is the investors in these particular securities have certain expectations about when they'll get paid on average, how much they'll get paid. So one of the issues, even if you pay at market rates, is that you're pulling a particular mortgage out of the pool, and so you're affecting the prepayment speed, which is a complex concept, but it's something investors rely on. It could have some impact on future liquidity and pricing. That being said, if we're looking just at private label, which was the Wall Street, there's Fannie Mae and Freddie Mac securitization, which was backed by the government, and then there's Wall Street private label securitization. Private label, that may not be as much of a concern because that's kind of dead right now. There's no private label securitization happening. And also mitigating what I just said, I think most people, including investors, probably recognize that this is kind of a once-in-a-lifetime historic disaster, and so they may build that in on top of the lack of institutional memory that Professor Kanner mentioned. So it's kind of an either-or, who knows. Yeah.
Yes, sir.
I'm Graham Williams. I'm the Chief Executive Officer of Mortgage Resolution Partners, and we introduced this idea to the marketplace. There's been a lot of conversations about our proposal. We haven't made a proposal yet. So facts are funny things, but let me give you a few facts. Our program focuses on 10% of the mortgages in the United States, 5 million loans in private label securitizations. There is no intention, never has been, of our programming affecting any other mortgages. According to Fannie Mae estimates of default, 3 million mortgages in private label securitizations will default in the future, adding to the pipeline of defaults. Given David's estimates, that's roughly 40% of all foreclosures will come from 10% of the marketplace. How can this be? 92% of private label securitization loans in the Sacramento Valley are underwater. The likelihood of a PLS loan being underwater is 5 times the likelihood of a non-PLS loan being underwater, having an LTV in excess of 115%. These are the toxic assets. These are half of the future foreclosures in this country in 10% of the loans. The people in San Bernardino didn't ask for this problem. In San Bernardino, there are 42,000 homes eligible for our program. Applying the Fannie Mae default rate to this program avoids 26,000 foreclosures. Foreclosures may be efficient for the bondholders, but they're actually not as efficient as our program. Our program creates value by paying the bondholders more than they would realize through foreclosure on a probability-weighted basis. Our proposal...
There's a question here somewhere, yeah?
No, there's no question.
Oh, okay. All right.
There's clarification.
Okay.
As to the San Bernardino housing market, in 2006, 7.5% of the homes sold in San Bernardino were sold to people who bought them to rent them to somebody else. In March of 2012, 30% of the homes sold in San Bernardino were bought to rent from someone else. Who bought them? The same guys who brought you this problem. Right? They're forming funds. They're buying foreclosed homes. They broke it. Now they own it. These are tough facts, but true. As to the cost of housing, people can rent houses. The cap rate on houses, that means the amount of rent charged by these people that are buying these houses, is 10%. 10% of $200,000, which is the price, roughly the average value in San Bernardino, is $20,000 a year. That's 40% more than the principal and interest payments on a mortgage for that same house. They bought it, they broke it, now they're going to own it, now they're going to make 10% unlevered returns on it. As to just compensation, key issue, we stipulated in a paper I wrote and was published about 6 weeks ago, our purchase price for these loans, this is an important point, no one's losing money. Fannie Mae owns roughly 10% of these bonds. Our program pays Fannie Mae what they have on the books for these loans. In other words, if Fannie Mae took our offer for these mortgages, Fannie Mae's already written these down. We'll pay them full face of what's on their books. There's no loss to Fannie Mae. There's no loss to any other bondholders. The only thing that's lost is the opportunity to control this process, turn these houses into foreclosures, turn them into rentals, and make 10% unlevered returns. Because the homeowners stay in them. The homeowners gain the appreciation from the homes. That's what's lost. It's lost opportunity. There's no loss in value. As to Kelo, there's a popular perception about this program, if you've studied it, the program we haven't announced, that the asset will change hands from the community to a third party. Absolutely not true. In Kelo, there you go. In Kelo, the asset moved from the government to a private party. Here, the asset moves to the government offers a short refinance, and the government gets paid off. No transfer of the asset.
But the beneficiary is the borrower.
Pardon me?
The beneficiary
Absolutely,
is the borrower.
the beneficiary is the borrower.
Isn't that a transfer of wealth to the borrower?
Who does it cost money to? I just pointed out we're going to pay the full value on the books, right? We're going to take defaulted loans. We're going to avoid several thousand foreclosures in San Bernardino alone, 24,000 by my estimate, and there's no cost to anyone. Now, the bondholders have already written down these bonds. The face amount of these bonds is $1 trillion. The market value is roughly $500 billion. The bondholders have already taken a loss. They've written these down. Just take a look at the Fannie Mae books.
I don't think we have the time to unravel a lot of the many things that you have said. But as for me, whenever I hear somebody say that some major operation is going to take place with the involvement of the government and it will involve no cost, my reaction is to grab my wallet and head for the door.
It's just politics. That's your point of view. That's
No.
way to do it. But I just clarified a series of objections to this program. If you'd like to address those, we can have a conversation.
We need a lot more time than this.
Well, we are running out of time. Did you guys want to react to?
Some of the numbers that are cited there, they've gone to the point of using Zillow data to determine valuation in the region.
Not true.
It is.
It isn't true. We
look,
got those
the-
numbers. That's not how we got them.
You know, another area we haven't seen how exactly they're going to work the announcement on non-performing assets is one that's pretty recent, and we'll have to wait for some details on that because one of the key aspects is that in order for the program to work, the individuals have to qualify for financing in order to come out on the other side of this and bring the money back to the investor.
You haven't seen our program. I don't know how you can make these comments. That is absolutely not true.
I've got a copy of it. Do you want to see it?
Well, we can chat afterwards, but are you almost? We're almost out of time.
I'll complete there. Thank you.
I can't speak to the specifics. I guess I'd just say, there are problems with foreclosure. This is not an efficient market activity. Anybody looking at this set of loans on the books that have declined in value as an aggregate asset class can't say that the markets are operating efficiently here. I think Doug just wrote a paper arguing something to the same effect. And so this is the classic time in market theory where you'd have the government intervene. I'm not sure this is the right solution for the reasons I mentioned before. I think it's just it's too timely, it's too costly as far as litigation and other costs. But I think that there is a real need for solutions out there.
Well, this was terrific. Thank our panel. And thank you. Well, now we're going to take sort of a more global look at housing in California. And, of course, next to me is Doug Holtz-Aiken, the president of the American Action Forum and the former head of the Congressional Budget Office. And just maybe it's easier. Why don't you guys just introduce yourselves?
I'm Richard Green. I'm director of the USC Lusk Center for Real Estate and a professor in the Price School of Policy and the Marshall School of Business.
Great. I'm Darren Bloomquist, vice president at Realty Track down in Irvine, California.
Which I use a lot to follow real estate issues.
Good. Yes.
I'm Jed Kolko. I'm the chief economist at Trulia, the online real estate site based in San Francisco.
And Mrs. Lucas would want me to say that she's a proud USC graduate. So what is the state of housing in California?
We start with the real experts in California. Why don't you start this way?
Okay. Go ahead.
California is, as always, significantly different from the rest of the U.S. It has masqueraded during some parts of this housing crisis and recovery as being very similar, but never far from the surface has been the issues that make California pretty much unique in the country in terms of its housing market. Yes, California had some of the biggest price declines, particularly in the inland part of the state, and some of the highest foreclosure rates. But this is all set against the backdrop in California of the extreme difficulty in building housing, particularly along the coast, and the fact that even now, with the price declines that we've seen in California, the typical home in California is a multiple more expensive than the typical home elsewhere in the U.S. And so California, over the past few years, has suffered the twin challenges both of steeply falling prices and high prices. Now, these are two problems that shouldn't really be able to exist at the same time. The steeply falling prices, of course, have resulted in lots of underwater borrowers and a high foreclosure rate, as in many other parts of the country. But the fact that prices remain high, particularly in coastal California, remains the most important high cost of doing business for businesses that would like to be in California, and a cost for people, particularly, again, in the coastal parts of the state, that want to live here and can't afford to. It raises a couple of other issues. One, right now, as part of the recovery, we've seen nationally a pretty significant decline in inventories. This has been a national trend. Inventories are down year over year. between 20 and 25%, depending on who's measuring it. Several reasons for that. Some of that is fewer foreclosed homes on the market as foreclosures have worked through the pipeline and been sold. There's also the psychology now that prices are rising in most of the country, that buyers get impatient, having fear that they've missed the bottom. Sellers get a little bit more patient in the hopes that prices might rise a bit more. All this together has sharply contracted the inventory. This is even more true in California than elsewhere, where inventory is down closer to 40% in many parts of the state. Prices are rising here, more in the Bay Area than elsewhere. But above all, it means that, particularly on the coast, vacancies have gotten extremely, extremely tight. We're back in the situation where California has long been, where there are very few available units, either to buy or to rent. Now, for homeowners and those who have a place, this is good news because that supports price increases if there's very little available supply on the market. It is a challenge, of course, when it comes to affordability and for people who are looking for a place, whether to rent or to buy. So we're at a point now where California is now sort of waking back up to some of the long-term problems that California's housing market faces, even though the state is far from finished with its hangover from the housing crisis with its high foreclosures.
But, I mean, there's still this bifurcation, right, between the coast and sort of the central California.
Several. There are actually three different markets right now going on in California. I mean, there are, dozens. But, if one were to sort of crudely clump them together, on one hand, you've got the Bay Area. The Bay Area, particularly San Francisco and San Jose, we've seen the fastest job growth year over year in the country of any metro area. Strong price increases and strong rent increases year over year, some of the tightest vacancy rates and most sharply falling inventories in the country. That's what's going on in the Bay Area. Southern California, job growth has been weaker. We've seen much less price appreciation in Southern California, even along the coast. Still tight vacancy rates because it's hard to build, but not the same kind of price rebound and return to normalcy that we've seen in the Bay Area. Inland California, the huge decline in vacancies, there still is a foreclosure problem, though not as sharp as we see in Florida and other states with the slower judicial foreclosure process. So there are really three different recoveries going on right now. There's the Bay Area, where when we look at price appreciation, when we look at the rate of construction, in many ways things are back to normal in San Francisco and San Jose. Not as much the East Bay, but in those areas, yes. Southern California, still relatively little in terms of price recovery, though in better shape than Inland California, where there have been such big declines, still not a huge price rebound, and some more foreclosures still to come.
Darren?
Great. Speaking of foreclosures, that's our focus. And I could say the same thing that you said, Jed, about home prices with foreclosures, that in California, foreclosures have been decreasing really for the past 3 years. And California is ahead of the national trend when it comes to that. Nationally, we've seen about 22 months of decreasing foreclosure activity. California led that trend. It's about 33 months of decreasing foreclosure activity on a year-over-year basis. But we have that decreasing foreclosure activity for 3 years, but yet California still has one of the nation's 5 highest foreclosure rates in the country. Consistently, it was number 1 for a couple months earlier this year. So, and then if you look at some of the markets within California, like Sacramento, especially some of the inland markets, you see those consistently in the top 10 to 20 metro foreclosure rates in the nation. So we've seen this 3 years almost now of decreasing foreclosure activity, and yet the foreclosure rates are still high. It's a persistent problem. These foreclosures are not going away overnight. And the way I describe it is we've got a lot of silver linings popping up, but there's a lot of still dark clouds in front of those silver linings. And so falling foreclosure activity is one of the silver linings. The dark cloud is that the foreclosure rates, especially in California, are still high. Even nationally, foreclosure rates are at 3 to 4 times what we would consider normal. The second silver lining is fewer foreclosure sales, and Jed alluded to this earlier as well, that there's fewer foreclosures selling. In nationwide, foreclosure sales were down 22% in the second quarter after 5 quarters of decreases. And so this is where the rubber meets the road, when these properties that are in foreclosure or bank-owned are actually selling. So we're seeing a decrease in that, but the dark cloud still is that these foreclosure sales represent 23% of all sales. And so nearly 1 in every 4 sales that's happening is still a foreclosure property. In California, it's higher than that. It's probably around, it's actually close to 40%. So
You mean
still,
in different markets of the state?
California as a whole, 40%. In Sacramento, I think, for instance, it's about 45% of all sales we're showing are foreclosure related. And then on top of that, we have the banks are moving further upstream to dispose of these distressed properties. So we have another 14% of all sales that are what we would consider short sales before the foreclosure process even starts. And so homeowners in trouble, they're not making their payments. The bank doesn't even bother with starting the foreclosure process. They go ahead and, in some cases, proactively promote a short sale. And we're showing that represents another 14%. This is nationwide on top of the 23% of properties in foreclosure that are selling. So if you put those two numbers together, it's about 37% of all sales are distressed sales. So again, there's fewer of them happening than there were, but it's still a very high level. We would consider normal to be under 5% of all sales being distressed sales, and that's what we saw back in 2005, 2006. And then the third silver lining that I thought of was the rising foreclosure prices, and this supports the idea of overall rising prices. But we're seeing in the second quarter, again, a pretty dramatic shift after several quarters, over a year and a half, of decreasing prices, average prices in foreclosures. We saw a 7% year-over-year increase in average prices of foreclosure properties. And that was the first year-over-year increase since the second quarter of 2010. It was the biggest since the fourth quarter of 2006. California's actually was not quite as dramatic. It was about 5% increase in average prices. Now, that was statewide, so I think if you do drill down into the Bay Area or in some of these areas, coastal areas, you will see even bigger price increases in those foreclosures, particularly in the REOs, because there's fewer REOs selling. It's creating a lack of supply. And, I've heard from agents here in Sacramento that they want, I had an agent tell me, real estate agent, we want more foreclosure inventory. I hate to see people lose their homes, but we want,
good for business.
My buyers, yeah, exactly. My buyers want more foreclosures to buy. So that's an interesting phenomenon that's happening kind of as a result of the slowdown in foreclosures last year, what I would consider an artificial slowdown in many parts of the country. In California, maybe not so much. So that's a pretty big silver lining. I think the dark cloud there is that this increase in foreclosure prices could be a little bit of a false bottom. I don't necessarily see that in California as much as some of these markets, as Jed alluded to, that have the longer foreclosure process, where there's more chance for a backlog of foreclosures to have been built up that are still coming, that we haven't seen yet. The longer foreclosure process kind of creates those dark corners that stuff can get hidden in, and all of a sudden it comes out. And so I don't think we have as much of that in California, because the foreclosure process has been, it's about a year, but that's much better than a place like Florida where it's 861 days, or New York where it's over 1,000 days to complete a foreclosure. So,
Professor Green?
So first of all, I just want to say that it's sufficient information about you as a parent that you turned on your kid to Monty Python, so you don't have to say anything else.
Okay, thank you. I don't have there's not a lot in my plus column.
The other thing about it, I think it's important to note that 1,000-plus day number in New York, that's even a truncated number, because there are houses that have been sitting in foreclosure that haven't been resolved yet. And so this is a classic case. We have a problem of censorship bias. It's even worse than...
Yeah, because we're looking at ones that have actually
gone to resolution.
Yeah. How long they took. Yeah.
So I guess I'm going to talk just about California, because a lot of the rest of the country is still pretty depressing. And California is actually looking better. And I'm going to say something a little strange, I think. I agree with Jed that you really have to segment the market in California. Actually, to say there's a California market is not right. But that the short-run fundamentals in inland California are actually better than they are in coastal California, but the long-run fundamentals on the coast are better than they are in the inland areas. Why do I say that? Well, we heard why. When Graham made his comments, he was complaining about a 10% cap rate for investors on buying houses and renting them out. That's a good return. That means to me the price is where it should be. In fact, if anything, it suggests it's a little low because these are investors making a really nice spread over treasuries right now by buying houses. That, to me, is a very powerful fundamental driving the market right now. Whereas if you go to the coastal areas, you still see very, very low cap rates, and particularly in the Bay Area. If you look at what rents are in the Bay Area, and they have been rising. And by the way, in LA, they've been rising very rapidly, too. You're right about values, not so much, but rents in LA are rising very rapidly. But still, that return on a house is much lower along the coast than it is in the center of the state. And the second thing, and one other point, investors are buying this stuff with cash. So this isn't a levered play. This isn't somebody else's money. This is, we fundamentally think we can make money by investing cash in these things. And that, to me, is a pretty powerful thing. And the second thing is if you look at price-to-income ratios, again, in the center of the state, they're much more in line with long-term history than they are on the coastline. And so you look at, do people have enough money to buy the houses at the prices where they are right now? In the center, yes. If you go to the coast, the answer to that is still no. LA County median house price to income ratio is about 5. And normal is probably more in the neighborhood of 3. So that's why I say short-term center is actually in better shape than the coast. But in the long run, the coast is going to be better off. And there are two reasons why. First of all, if you look at, use the bloodless economics term, human capital, you have incredibly different markets on the coast and the center of the state. So if you start in San Diego County, Orange County, even LA County, which is very diverse, Ventura County, Santa Barbara County, et cetera, the share of the adult population with a BA is higher than it is nationally. And of course, in the Bay Area, it's much higher than it is nationally. And we know that returns to education have been widening over time. And so the income that's needed in order to buy expensive houses is going to be there on the coast. Whereas if you look at the inland counties, Imperial County, Riverside County, San Bernardino, Kern, and so on, the share of adults with a BA is much lower than it is nationally. The national level is about 28%. In San Bernardino County, it's 15%. And so I don't see people having the incomes to afford houses that are much more expensive than they are right now. So they're reasonably priced right now, but I don't see a whole lot of upside going on there. And the second thing is this issue about elasticity of supply. Is if you look at California as a state, and go back 20 years, you look at how many households have been added, you look at how many houses have been added, they're aligned with each other. We've built the right number of houses given the number of households we have. That's very different from Arizona, that's very different from Florida, and so on. But we built them in the wrong place. So Fresno, we built a whole bunch of, I don't know, what do you mean we, Kimasabi, but builders built a whole bunch of 4,000 square foot houses in a city where typical household income is $36,000, $37,000 a year. Those houses, people think I'm being facetious. I'm serious about this. Somebody should go in, put a partition down the middle of them, put a kitchen on one side, and turn them into duplexes, because there's not going to be demand for that stuff. If you look at the coast, on the other hand, we just haven't built a lot of houses along the coast. And Matt Kahn at UCLA had a really nice paper appear in the Journal of Urban Economics about a year ago asking, are liberals more likely to be NIMBYs? And his finding is yes. So when you have a NIMBY attitude, you're going to have fewer houses built in the face of rising demand, which is bad for low-income people, but is good for the trajectory of house prices. And then the final thing, Jed, when he was at PPIC, did a paper that looked at topography and house prices, and he found, yes, indeed, the fact that the coastal cities are up against the ocean and the mountains has an impact on their prices as well. So that's why I think long run the coast will do better than the center. But in the short run, the center's looking a lot better than it's looked in a long time.
Doug?
So I'm not an expert in California, which is why these guys are here. But it is interesting to look at California compared to a lot of the rest of the United States. And as a caveat at the outset, there is no single market. And we track 350 different housing markets at the webpage for housing at American Action Forum. But in stylized terms, California does look like some of the rest of the U.S. and is different in some ways. First is, it's a bubble state. If you go to an Ohio, for example, which has comparable foreclosure problems, they never got a housing bubble. They had a broken economy. People tried to get the cash out of their houses. They ended up in big trouble. And it's a very different set of characteristics when you look at that housing market versus California, which generally had the bubble and then the big decline. And so it shares that characteristic with the Arizonas and Nevadas. It does get through foreclosures pretty quickly. I mean, it's a non-judicial state, and that's a characteristic we see in places that tend to recover, are starting to recover more quickly. The bad news on the California front is that compared to some of the other places, there hasn't been as much job creation statewide. Again, I guess there are these differences, but unemployment rates remain relatively elevated. And what we're seeing broadly is that for there to be a housing market recovery, you've got to have better employment and income growth to sort of get people into the market. We created, roughly speaking, over the past 3 years, every new household creation in the United States has gone into rental, not into owner-occupied housing. And we have to generate the income to get some of those folks into the demand side of these markets. And it happens in some places, but it's not happening in others. And I don't think it's broadly happening in California. I may get corrected by the local experts. For sure, it doesn't look like New York. As a former resident of the state of New York, the right way to figure out how to do something is to look what New York does and do the opposite. So we know it doesn't look like that. And then I guess, California has suffered along with the rest of the U.S., but perhaps given its size and the size of its housing markets, it's suffered more from what I view as the stop-start nature of federal housing policy over the past 3-4 years. I mean, we've had 14 different federal mortgage modification programs. Each time we go through one of these things, everyone stops, waits, see if they're going to get a better deal. We don't see housing markets clear. We've seen a lot of litigation. We saw that in California, slow things down as well. I have come to the opinion that we need to stop inventing clever new policies and just let these markets clear and try to get the economy growing as fast as possible to help them clear. That's 180 degrees from where I was in 2007, 2008, when I was a big believer in very, very clever housing intervention programs. I was on the McCain campaign as the economic and domestic policy advisor, and I invented 4 or 5 incredibly clever, I must say, ways to fix this problem, all of which would have worked, and all of which had the same characteristic, which is people hated them. And I have come to the conclusion that the following is Holtz-Akin's theorem: there is no large-scale, economically meaningful housing intervention policy that is politically feasible, because all that involves, in the end, a fair amount of wealth going from one part of the economy to another to fill the negative equity hole. The politics just don't support it, and I think, given that reality, we ought to stop changing policy so quickly, let the markets clear. It's painful on the ground, but it is the way forward at this point, especially at this point. So I'll just stop there.
Basically, every housing policy debate that we've seen over the past many years has run into the same 2 problems. In the end, almost any policy you can think of that would have helped or done anything in this crisis, first of all, would have cost somebody some money, and second, would have risked some kind of moral hazard, which means that you can't separate those who deserve to be helped from those who might not have deserved to have been helped, and therefore might have encouraged the wrong incentives in the future. Now, the reason why these 2 issues become a political logjam is Democrats and Republicans feel very different on both of these issues. When we've done our own surveys at Truly of consumers and their attitudes toward housing policy and everything else, Democrats and Republicans feel very differently about spending money on housing. Republicans are much more likely to prioritize reducing the federal budget deficit, reducing the national debt, than Democrats are relative to various housing policies. And Democrats are also much less concerned about introducing moral hazard than Republicans are. In terms of agreement with statements like, it's okay to help some undeserving homeowners in order to keep more people in their homes. Which means that basically most policies you could think of will have a pretty predictable partisan lineup. And we saw this very clearly with the principal reduction fight this year, which was, without a doubt, the most entertaining housing policy fight. Watching the FHFA acting director basically line up with what is more the Republican view, both on the question of spending money and the question of moral hazard, than with the Democrats. In fact, principal reduction or not, would have been a fairly small issue in terms of affecting the housing market. It would have added one more tool to an existing set of tools that would have had, maybe a marginal effect on whether people stayed in their homes. Certainly not the effect on the housing market that you might have thought people were fighting over based on how shrill that debate was. But again, most things cost someone money and introduce some kind of moral hazard. The one policy that really doesn't bump into those things has been the REO to rentals program. Pilot program, not widespread. That had other issues, still has other issues, which is basically that the REOs that you might rent out aren't in neighborhoods where there's a lot of rental demand. If you could take those REOs in suburban Sacramento, pick them up, put them in downtown San Francisco and rent them out, great. That's not how REO to rentals work. The houses tend to stay put. But pretty much every other policy we can think of, risks these issues of costing someone money or moral hazard.
So there's a policy change that's happened in the last couple of months. I guess it happened in February, I think, that actually I think has helped, and that's HARP 2. The idea of letting people who are current on their mortgages refinance regardless of their equity position, I think was a really good idea. And by the way, this is something that I think, since we were talking about partisan stuff, a lot of Democratic and Republican economists thought was a good idea. Glenn Hubbard has been pushing this basic concept for about 4 years now. And it's important for a couple of reasons. First of all, you're not rewarding bad behavior because it's only people who are current on their mortgages who are eligible for this. You are not, in a sense, giving those people anything they didn't have to begin with, which is that normally people have a call option on their mortgage when they get a mortgage in the United States. We're just saying you're going to be allowed to exercise it right now. And it does something else that I think is really important. Before I get into that, I want to note something. The vast majority of underwater borrowers are current on their mortgage. And I remember Ken Lewis, who was the CEO of Bank of America, was quoted 4 years ago saying, people don't care about paying their bills anymore. Well, it was a group of people who couldn't get mortgages before who are now getting mortgages that didn't pay their bills, and it was kind of predictable that they don't pay their bills because if you look at their FICO scores, they didn't pay their bills. People who pay their bills continue to pay their bills. But the problem is if they run into stress, they lose a job, somebody gets sick, they get divorced, and then they see they're upside down, then they're going to go into default because, who could blame them for doing that? So what HARP does that I think is really important is it's leading people to convert their 30-year mortgages into 15-year mortgages. And we're seeing a pretty substantial number of people do that. And why that matters is because they're building up equity much faster, which means the amount of time that they get right side up reduces substantially. So do the following experiment. Go from a 6.5% 30-year fixed to a 3% 15-year fixed, and that's where 15s have gotten down to. And you're 20% underwater. You have moved from it taking 11 years to get right side up with no house price appreciation to 4. And I think if people can see that they have equity in 4 years, that's a pretty powerful incentive not to default. So I think...
Well, and there's a ripple effect in the economy, right?
Yeah.
By that confidence?
And so I think HARP, and the take-up rate of HARP 2 has been much better than previous programs. So I think we have to give it a little bit of credit for helping.
Two things about...
disagree with that. I just think that the sort of whirlwind of different programs, again and again, really did serve to be, in the end, detrimental to getting things going. I think that's it. The other thing that got left out, at least in my summary, is overall credit conditions right now are really miserable. And that is, one, true to just pure overreaction. There are people with, 780 FICO scores and putting 20% down and can't get mortgage. You hear these stories all the time. It's like, what is going on? And then there's the general credit problem, which is between financial regulation reform in the U.S. and the Basel Accords and these banks are just spinning, and they aren't giving loans out to anybody. And I think this is really hurting the housing recovery.
Yeah,
Briefly, and then we'll go to questions.
One quick thing about HARP, and then just one more general comment about housing programs in general. A couple quick things about HARP. First, totally agree that most people fall behind on their payments for sort of stress events, sort of health, unexpected health costs, losing a job. The problem with HARP is that it equates being current on your payments as being deserving. And that's been the language that has always been used around we're not going to let people who aren't deserving refinance. And the measure for that has been being current on your payments. Those aren't the same thing. Again, moral hazard makes it difficult to tease that out more appropriately. But given that most people who fall behind are not falling behind because they're not deserving of help, means that lots of people who probably should be helped aren't being helped by that rule. The second is, what does refinancing really do? Clearly, refinancing is an economic stimulus that doesn't need congressional approval. In part, that's why it's been so appealing to many. It is less clear the extent to which it prevents people from losing their homes, particularly if you need to be current on your payments to qualify for it. There's been some interesting research recently that shows that refinancing would make it less likely that some people would default and lose their homes, but probably not as much as programs that, in addition, would directly lower loan balances. Of course, now that prices are rising in most parts of the country, people have less of an incentive to default in the first place, which is one of the best kinds of loan modification policies there are. The last quick thing on housing policy in general just goes to the range of programs that we've seen. I once tried to sort of lay out for a reporter the different programs that there are and how a consumer might figure out what they would be eligible for.
What's your first mistake trying to lay it out for a reporter?
So, it depends, first of all, are you current or not? What your your payment to income ratio is, who services your loan, and it means that people who, in the most important ways, could be in very similar situations, have had the same history, similar value, might be eligible for very different types of programs, whether they're one of the five, serviced by one of the five lenders that are part of the robo-signing settlement, whether they've got a Fannie Freddie guaranteed loan or not. And so, even if some programs work, it's a patchwork. And people who should be treated similarly by our housing programs aren't. It causes confusion. Understandably, it causes cynicism about housing policy. Again, even if the individual policies are effective, the fact that it's been a patchwork, I think, has made housing policy in general more of a challenge than it could have been.
What would you like to hear them talk about? Look, they're completely satisfied.
Cool. They've had enough of the housing economists. That's never happened.
Yeah, Paul?
I have a question. There's discussion about the lack of inventory in the inland areas in particular. In our area, we're down to, there are communities where traditionally there are 1,400, 1,500 listings. Moreno Valley is one of them. And today there's 144 homes on the market. And the majority of those are unsellable. They just stick there. For home buyers, just traditional home buyers trying to get financing and buy a home, it's very difficult. It's pushing up real estate values. Do you have a sense for, because we're seeing now declining volume due to the lack of inventory, do you have a sense for how this is going to affect values in the short term? And given that it's a small slice that's actually changing hands, does that create the danger of some kind of renewed bubble that's built around a small cross-section?
Yeah, so you're not going to like the first part of this answer, so I'm just warning you first. Right now, nationally, inventories are around long-term normal levels. They're down more than 30%, 35% from where they peaked, but that peak was an extremely elevated inventory when there was a glut of unsold vacant homes. So right now, NAR's most recent estimate of existing homes for sale on the market is right about national normal levels. Now, that doesn't mean it's normal everywhere, but from a national perspective, This is around where inventory is likely to be. There are a couple of different things going on with inventory. Now, prices, again, are rising, both asking prices, after you adjust for the mix of homes and seasonality and everything we should adjust for. Asking prices are rising, as are sales prices in most parts of the country. They have been for much of this year. That has an immediate effect on inventory and then a longer run effect on inventory. The immediate effect of this tends to be to reduce inventory even more. Buyers, when prices are rising, get impatient. They don't want to miss the bottom. Sellers get more patient. That sharpens the inventory declines. Sellers will not stay on the sidelines forever. Those are waiting to be back above water or simply to feel like they've seen enough of an increase in the market that it's worth selling, as well as banks and others who are holding on to lots of properties who want to see bigger increases will add inventory to the market. New construction also will add inventory to the market, but that's not instantaneous. Typical single family takes about 4 months from permitting to completion. Multi-unit buildings, typically a little over a year. So there is a lag, but the decline in inventory that we see right now, first of all, has gotten us nationally at least to normal levels. It's an essential step as part of the recovery, given the elevated inventory that we had, and it won't last forever. As more sellers feel comfortable putting their homes on the market, and we see more construction.
And I think we are seeing, there are some signs, not so much in California, but even in August in places like Fresno, Merced, there were some pretty big spikes in properties starting the foreclosure process. So that may be a sign that banks are saying, hey, now's a good time to get these properties sold. I think in Fresno it was over 100% increase from July to August in foreclosure starts. So there may be some of that. I don't think it's going to be a flood of foreclosures that maybe some people had predicted at one point, but it's going to be, there's more there that's going to be coming through the pipeline. But definitely, our numbers show that California has a lower supply. We estimate 9-month supply of REO inventory in California compared to 15-month supply nationwide. I looked at Sacramento, a 7-month supply in Sacramento. So, and I think a lot of the inland areas are like that.
Yeah, and given the faster foreclosure process here, California, has roughly had about 3/4 of the number of foreclosures it will ultimately have as part of the housing crisis. Florida's only about halfway done. New York State, closer to about 1/4. So huge differences based on the length of time that it takes homes to go through the foreclosure process. Wishing for more foreclosures so there'll be more inventory, obviously that's not the solution. No one's suggesting anyone's saying that. But it does mean that more foreclosures in California still to come probably isn't going to be what has the biggest effect on inventory going forward. It will in Florida. It will in some other states where there are a lot more homes in the foreclosure inventory. Probably not here.
You were going to say?
Well, I was just saying, if you look around these different housing markets and you look at the three things that are key on this supply side. First, housing prices rising. We still aren't at the point where we've got, a solid 75% of those markets with year-over-year increases. We're getting there, but we haven't gotten this sort of uniform increase that the national reporting might suggest. So we're not seeing that. And then I think the key issues on the new construction versus, foreclosures and other sources of inventory. That mix has yet to move toward anything serious on the new construction side and nationwide. And until we see that, the housing market's not out of the woods.
Sir?
Just one point on foreclosures on the inventory for sale is that I happen to know the numbers, Paul, that 40% of the foreclosures are not being sold by realtors. They're not listings. So 40% of the foreclosures are being sold at the trustee sale to investors directly. So they never show up on the inventory. And that number is up from about 10%. The traditional process where they got listed is eroding because investors are buying them directly.
Yeah, we saw, there's been a lot of talk about buying foreclosures as rentals. We're actually looking at a big increase in flippers. Flippers are back if they ever left. But we saw a 25%. In the first 5 months of 2012, properties that were flipped, not just foreclosures, was up 25% from the same time period in 2011. I think it was in California, if I recall, it was like a 40% increase.
We saw when we were in Phoenix. Phoenix had shown a fairly, on the numbers, a fairly good recovery, and it seemed to have characteristics of the kinds of places that recover well. It has a broader employment base, for example, than Las Vegas, which is very tourism concentrated. They'd gotten income and job growth, and the house prices looked like they were doing pretty well. But when we started listening to the folks who were following that market, a lot of it is cash purchases by investors, and they're worried about, like a little mini bubble, some of them. And it was a sobering discussion.
David?
This is a question for Doug. If I understand you correctly, you're basically saying you would, when you talk about the markets clearing, you're not getting rid of existing programs, but just simply not adding new ones. Is that right?
Yeah, stand down, nothing new.
Yeah,
and let's just settle.
So if you were president, or if you were advising the president,
don't get my hopes up.
what would be? Would that be a significant departure from the status quo, or would we expect to see something similar to what's going on now?
Well, I'd be, I'd stop harassing the poor FAA director, leave him alone. He's doing his job and doesn't need to be publicly excoriated. I would certainly. Please ask the senators to stop. We don't need new legislation in this front. And I would, focus aggressively on a strategy which, instead of saying that you've got to fix the housing market to get broader macroeconomic recovery, let's get a better, broader macroeconomic recovery to pull the housing market along. And that's one part economics, but one part politics. I just really think that the political economy for, as I mentioned, of large-scale housing programs is dismal. So there's no point in getting into it.
With the senators, but to the extent you're advising...
Easily controlled bunch, yes.
The Federal Reserve and talking, would you try to influence them in any direction?
Oh, I am not a fan of QE3. I was not a fan of TWIST or QE2. The Fed was the single most important and best policy reactor in the crisis. They did a phenomenal job of being a lender of last resort to pieces of the economy where they didn't have good conduits. They invented them. You can't say enough good things. They are the single most important reason we got the turnaround at the rate we did, particularly in the financial markets. But everything past that has flunked the benefit-cost test, in my view. I think they feel they have to do something, and I understand that. They're not getting much help out of Congress. But these are not efforts that have done much for housing or for the economy as a whole.
Well, let me just piggyback on that for a second. So, Richard, is there something the government can do beyond HARP that would be a plus, a positive?
Well, so I want to make clear, I actually agree with Jed. I would like to see some principal reduction program, and I'll be very specific about that in a second. But the point is, we have what we have, and I think HARP 2 has been a materially beneficial thing, and so I didn't want to let that go. One of the things that's really striking to me is the difference between commercial real estate and residential real estate with respect to distressed mortgages. So if you look at David Geltner's webpage at MIT, and you look at what happened to commercial real estate values, they took about as big a hit as residential real estate values did. Not quite as much, but in the same ballpark. And lots of guys were underwater on their commercial real estate. And one way commercial real estate is different from residential real estate is the loans tend to have short maturities. They amortize over a long time, but they mature after 5 years, 10 years at the latest. So what happens when you have basically a need to refinance, and you don't have any more equity? Well, the way the commercial real estate market works is the lender and the borrower get together, and the lender says, pay me back. The lender says, pay me back. The lender says, pay me back. And the borrower says, well, that Circuit City that was in my shopping center, it's not there anymore. So the income I had before just isn't there anymore, and nobody's going to lease that space. And they come to a workout. And so long as the borrower is reasonable and doesn't trash the property and is upfront about what's going on, the lender will usually say, okay, we're going to do a modification the following way, and they resolve it and they move on. And the way it works is both take a little pain, and they're grown-ups about it, and on they go. And the lender doesn't want it to show up in REO because that means it instantaneously loses a bunch of value. But they want to make sure that the borrower, say, brings a little bit of equity to the deal so they're not completely held harmless, and it works. And the inability of us to do this in the residential side has been a puzzle to me and reflects, I think, coordination failure. So to the extent, and I think we're starting to see it, the increase in short sales is, I think, indicative of people starting to figure this out. But methods for facilitating that kind of thing, I think, so making sure the tax law is extended is important so that if there's a short sale, there isn't a tax event as a result of that to the borrower. I think saying to borrowers, if you're in a market where prices have done 40% declines and you do a short sale and it's clear that you didn't trash your house and so on, you're not going to take the kind of credit hit on your FICO score that you normally would, because this isn't you, again, behaving badly. This is stuff really happened to you. I think that could be helpful, but I have no particular hope that this will
I think it's a slightly generous assessment of with the commercial real estate market. I mean, I think there's been a lot more of the evergreening of these loans, of not coming to terms with the real losses in value. I mean, it's like that old joke. If I owe you $100, it's my problem. If I owe you $1 million, it's your problem. A lot of these guys are getting, they're basically saying, I got to repay this loan, give me the money, and they've been doing it. And so I don't think we've seen, like we have in the housing market, the sort of lenders saying, the game's up. Let's find the market value of this house and move on. They've held some of those properties, I think, to a much greater extent.
Although interesting, that there's been a lot of recovery in commercial real
That's also
estate
true.
values.
The evergreening worked. They're happy about it. Yes, I know that.
So,
Yeah, one of the thinking about everyone takes a bit of a hit, but then works it out. One potential example of this, whose time may now have come, is shared appreciation as part of the price for principal reduction or other loan modifications. Now, that basically means that the borrower, after modification, doesn't get all the upside if prices go up. Now, this wasn't very interesting or compelling when prices weren't going up, and when it didn't look like prices were going to go up for a long time or ever. A reporter once asked me, will prices ever go up again? I did sort of want to say, they're probably not going to go to zero. But yes, prices will go up again. Now that they are, Romney's...
Except in Detroit.
Oh,
they did go to zero in Detroit.
Yes, but actually now rebounding almost as much as any place in the country. Romney's included shared appreciation in passing in his outline of a housing policy plan. What's interesting about this is, of course, it sort of deals partly with the moral hazard issue. If you're not getting all the upside, it doesn't give the wrong incentives to borrowers looking for a modification. That kind of shared appreciation could also go part of the way in maybe helping think more deeply about the eminent domain question. And given the earlier discussion that we heard today about how it's how do you sort of share some of the pain, some of the benefit. Thinking about how shared appreciation might apply to eminent domain. Again, I haven't thought this through, but is an example of the kind of compromise that could get folks who are on very different sides of a proposal a little bit closer together.
I was going to go for another question, but we're out of time. So tell them how terrific they were.
Yes,
And
I do, and I want to use the host prerogative to ask you to tell him how terrific he was, and thank you very much for coming.